Greetings. In the first quarter of the year, several key factors influenced markets. Firstly, economic activity in developed countries surpassed expectations, with inflation proving to be more persistent than anticipated, and labor markets remain tight. This led to a decrease in the likelihood of a recession and an increase in the probability of a soft landing. Consequently, expectations for interest rate cuts were tempered, causing bond yields to rise as rates were expected to stay higher for longer. However, equity investors remained optimistic, focusing on the resilience of economic activity and anticipating that future interest rate cuts were to follow, which are expected to boost corporate profits amidst improving economic prospects projected through 2024 and into 2025. Asset classes responded with a substantial divergence of returns, with global developed market equities returning 8.9% in the first quarter, taking the 12 months returns to 25.1%, while global government bonds returned minus 2.7% for the quarter. From the cycle low in October 2022, the MSCI World has returned 49%, emphasizing the importance of staying invested throughout the cycle. Within equities, the pattern of returns in the first quarter was the familiar one of US outperformance, with the S&P 500 delivering 10.4%, emerging markets underperformance, with the MSCI emerging markets only returning 2.4%, a continuing resurgence in Japan, with the Topix index up 18.1% in yen terms, and weakness in China, with the MSCI China index down minus 2.2% for the quarter. Although the Magnificent 7 mega-cap tech stocks in the US outperformed, gaining 13.4% in the first quarter, the scale of the outperformance was more muted and was dominated by two stocks, Nvidia and Meta, while others performed less well, with significant declines in Tesla and Apple, both which face specific challenges in China. Looking at the performance of our multi-asset solutions, the mixed numbers in the asset class returns were evident in the performance of our three multi-asset portfolios during the first quarter of 2024. The more growthier funds fared better as a result of the higher weight to global equities, which had a great quarter, and less weight to global fixed income, which continued to struggle in the first quarter of the year. Looking at the performance of our global multi-asset solutions, the Momentum Global Cautious Fund had a flat quarter in absolute terms, slightly outperforming its global cash target by 20 basis points. As a low equity multi-asset portfolio, the biggest allocation is the fund's 57% allocation to fixed income, which was relatively flat for the quarter. The rising bond yields during the quarter negatively affected bond prices, as there is an inverse relationship between bond yields and bond prices. Our balanced portfolio, the Momentum Global Managed Fund, had a strong quarter, outperforming its global cash target by 2.5%. The biggest contribution to returns were the fund's 57% allocation to equities, as global developed market equities continue to outperform. Despite the strong recovery in the fund over the past few months, the fund slightly lagged its 5-year return target, but points to much improved client outcomes compared to the same period last year. And finally, the Momentum Global Growth Fund also outperformed its global cash target by 4.5% for the quarter. As an aggressive asset allocation fund, the 86% allocation to equities meant it captured more of the equity upside, which bode well for the fund. The fund has successfully achieved its 7-year return target, further emphasizing the importance of staying the course. In conclusion, despite the risks and uncertainties, the current market outlook is optimistic, driven by the anticipation of a monetary easing cycle and the potential for a soft landing. We expect rate cuts in key economies to lay a foundation for market gains in the upcoming months. While mindful of elevated valuations and various risks like inflation and geopolitical tensions, our stance on risk remains constructive, but are adopting a patient stance before adding to either equities or duration in government bonds.